Hello, everyone. My name is Lucian. Most of you know me from Twitter as Triangle Investor. In today's edition of CEO and Market Expert Interviews, I'm glad to host Patrick Karim, a very well-known name in technical analysis, co-founder of NorthStarBadCharts.com. Patrick is also very famous on X, former Twitter, with more than 80,000 followers. Patrick, thank you for taking the time to come in my show. It is great to have you.
Hello, thank you very much for having me there. I can't wait there to cover some charts and see how the backdrop of those chart visuals can help investors see if they're at the beginning of a bull run or are they at the end, because it's very hard sometimes. Like, people read the news and let's say uranium, they hear something positive about uranium. But often you got to be careful, because when you start hearing news in the mainstream media more and more about an asset class, often they talk about it because the price went up, because people made money. They know they will get views, the mainstream media. And often that could be because we're closer to the end than the beginning of a bull run. But with charts, it's very easy because it's objective. We could zoom out and we could show exactly people where we are in the cycle. So hopefully
very well said. Yeah, I agree. But I mean, with this introduction, I believe I only have scratched the surface. So tell us the whole story about you. Who is Patrick Karim? How did you end up in technical analysis? Please, Pat, give us your background, your origin story.
Well, I'll tell you, look, I was like practically every investor that started. I'm a systems engineer, AIX, Linux. That's like what I used to do. Now I stopped that. Like when I started my website, I 100% now I do charts. But back in 2000, I was putting money in mutual funds and stuff like that. I didn't quite know, right? Somebody tells me that's what you have to do when you have spare income. But then in 2004, 5, 6, I started having more money. But it's like, I call it like the tourist trap. When somebody goes off the airport, let's say in Paris, and he's in Champs-Élysées, the biggest restaurants are usually the tourist traps. They're not the best. They're more expensive. It's fast, get the tourists in and out. But investing is the same thing. You go on Google, okay, investing money. Usually you'll go on penny stock forums. Like, I put some stupid amount of money in penny stock scams, pumps and dumps. I had no idea what I was doing, right? Very lucky I didn't get wiped out multiple times. At night, my heart was racing. So the next day I sold everything, but not based on TA, just based because I felt something was wrong. And then I was introduced to the book by Stan Weinstein, Secrets for Profiting in Bull and Bear Markets. And this guy is Stan Weinstein. For those who don't know him, he's like a pure technical analysis guy. He's world renowned. And in his first chapter, he was starting to write about casinos, how they were out of favor in the late 70s or early 80s. Nobody wanted casinos. The fundamentals were terrible. But he was looking at the chart and he was seeing a nice base. They were starting to break out. The price was trending above a 30-week moving average. And he says, somebody's buying this stuff. There's more buyers and sellers. I want to go in, even if the fundamentals are, people said, don't touch. And then that clicked with me. It made so much sense. But people are going to make money not on the fundamentals. People will make money if the price goes up. So fundamentals, it's fine. You could study it. But if the price does not agree, you're not making any money. So technical analysis, essentially, it's a technique to completely, if you didn't want to take care, if you didn't want to study, if you didn't want to do the research, all understanding everything, you look just at the price chart and it makes it so simple. So that like really crystallized in my head that it kind of gave me an edge, that I just look at the charts. I'd find entries where it'd be safer, probabilistic wise to enter. If ever I was wrong, well, I have sell stops. I could exit. I knew where the next resistance levels were, the measured moves. I would be able to exit taking profits, because it's very hard when the price shoots up, and everybody in the uranium sector knows this, or silver, when the price shot up in 2020 and started peaking, man, we were so happy. The bullish news, it's like, man, I'm going to be a millionaire. And then you start looking at higher up targets, and you start believing the price, or you start believing that the price is confirming your thesis or the fundamental narrative, but the price is just going up. But as soon as the price started going down, starting breaking moving averages, started breaking support, often
I understand that. I understand that your approach, your technical approach, but are you also relying in some percentages on the fundamental analysis? If you could say how much percentage is in your due diligence technical analysis and how much is technical analysis?
Look, let's say, can we like fundamental? Are we talking about fundamentals of the company, or
Of the
we're talking
company,
about
let's say. Yeah, yeah,
of the company? Because sometimes
yeah,
there's confusion because I do macro, like I do like what I call chart defined macro, but macro for me, it's let's say, and we could cover some charts for your viewers. It's
sure.
like, let's say the SPX performance versus gold. That's
Oh,
macro, that chart, that ratio identifies macro capital flows. And that will often carve out the actual price charts of smaller companies, the sectors within that,
yeah, 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 I got
like
it.
that. So that I do that. But the actual fundamentals of a company, if I cannot chart it, I dismiss it. So
Mhm.
I do dividend adjusted charts for companies. But I could chart that, right? There's you just click dividend adjusted, then you have the chart. I could see how the chart's performing on dividend adjusted basis. I also look at, now we look at market cap for liquidity. Before it's like penny stocks, I didn't care, but as any invest for a small amount of money, penny stocks is fine because you have liquidity to go in and out at your price. But as soon as you start having any serious amount of money, even if a penny stock's breaking out and the fundamentals are great, it's hard
Yeah,
because if ever there's you could lack liquidity. If the price starts going down, you want to exit, you're probably
yeah,
not going to get your exit the price you want. Even the entry is difficult, right? But a big cap company like, say, like Cameco, goodness, that thing could absorb hundreds of thousands of dollars, millions without the price really moving that much, right? You could get a
exactly.
good entry. That's probably the limit of what I look at fundamentals. The rest, look, I don't even look at the management. I don't care because this is the thought process, because everybody who's looking at the fundamentals, all the analysts, they're recommending to their hedge fund managers, they're pushing varying amounts of money. But
Yeah,
imagine you had all these guys working across the planet, pushing these billions of dollars, aggregated all together. It's the price chart.
yeah,
Essentially,
yeah, yeah,
all fundamentals, they're in the price chart. It, I cannot, I cannot be better than you at fundamentals. I cannot be better than Justin Huhn at fundamentals. I cannot be better. And if I try to do it, I'm a danger to myself because it's like, I don't know if you ever played poker. It's
yeah,
like,
of
oh,
course.
okay, I know the hands. I'll play, but a professional is going to destroy you because he knows the nuances. He knows how to read you. He's a pro. I'm
Yeah,
not a pro at fundamentals. I cannot even start that. I cannot put 10,000 of hours. I decided to put 10,000s of hours in chart trading. Uh, for me, it'd be super dangerous to even go down the route of fundamentals. I let
yeah,
all the pros do it, and um, I'll use the results of that, and I'll just analyze the end result of the price chart.
yeah. Uh, in my case, it's other way around. I have to admit that I'm not an expert in technical analysis. I'm familiar with the basics, but I have very good friends whose opinion I value very much. For example, yours. Pat, you are following a lot of sectors, and we will cover some of them for sure. But before we do that, can you tell me what are your top three sectors for entering now at this moment or in the near future, nevertheless? Uh, what would be those top three sectors that you would, let's say, give advice to average investor maybe to look at?
Okay, well, yeah, look, of course, it's like not financial advice.
Of course, of course.
The sectors right now, we're super lucky because we're doing the interview at the December 29th. It's daily close, weekly close, monthly, quarterly, annual close. We could get some great signals right now that are going to tell us where we have lower risk and higher reward entries.
Mhm.
Sectors that are going to be probably breaking out. There's some currencies. I don't like the Swiss franc is breaking out versus the US dollar.
Yes.
The Canadian dollar is starting to break out versus the US dollar. The even the oil and gas XOP there, oil and gas plays, they're breaking out on some time frames on their own
Mhm.
chart. So even oil hopefully we get to cover, even if oil price has gone down from the peaks and it's holding support, and I have a beautiful chart to show you how it's holding support. The oil tanker plays, they haven't tanked as much. Their relative strength versus oil is great. They're already holding up. Look, uranium right now, we're probably closer to profit-taking zone and for the next consolidation than we are at entering. If you look at Cameco broke out of a beautiful bull flag 5-6 months ago. That was the time to get in Cameco. Right now it's stretched. It's probably going to consolidate. There's probably some laggards in the uranium sector that are going to want to catch up, but it's not
juniors, probably explorers.
The juniors, the other ones. But look, Cameco is just a beast. It's like, I don't know anything about the fundamentals of Cameco, but I know that when I do a Cameco chart and I divide it by URA or by the uranium price, it's been outperforming all its peers. So I don't know what they're doing right. For some reason, the capital flows are going into Cameco. Is it because pension funds, they're allowed to invest in Cameco, but they're not? Is that how it works?
Yeah, the big money comes in chemicals and Nexgens, and the big money hasn't entered on the other scale, lower scale. So it's entering at Cameco and Nexgen and those big names. That's one of the reasons why are they on the all-time highs at the moment, some of them. But we will come to uranium. Let's cover first the general markets. The three main indices, Dow Jones, Nasdaq, and S&P 500, they are at all-time high, except Nasdaq. Sorry, I think it's very close to all-time high. They have all benefited from the impressive late rally boosted by the Federal Reserve, signaling that prolonged rate hiking cycle and rate cuts are likely done for 2024. Let's hope so. So, Pat, my question is what to expect in 2024 for major indices like Dow Jones, Nasdaq, and S&P. Can we expect a correction anytime soon?
Right. Well, maybe it's a good time. Maybe I could share my chart, my screen.
Please do. Yeah.
And then we'll get some visual support.
Sure.
All right. Right now here, I have the SPX. This for anybody who's new at chart trading, you have to put your time frame, your mindset adjusted to what the chart's showing you. Here, always look here. What the first question should be, what time frame it is, and this is a monthly candle chart. So each one of these candles has 1 month of data, so it reduces a lot of the noise.
Mm-hmm.
I have the 1-year moving average, look, a 3-year moving average, which is the red line. And essentially, guys, a moving average, the beauty of it, it's objective and unbiased. Like I haven't even started doing TA and lines and, like all that. There's nothing. Yeah. It's just, am I above an inclining 1-year moving average? Am I above an inclining 3-year moving average? And mathematically, to have an inclining moving average, you need data points above it, right? And as long as you keep having data points above the moving average, you're in an uptrend. Right now, look, nominally, the SPX is just doing fine there. It's above both moving averages, above the Ichimoku cloud, which projects support. It's above a high volume node right here. There's technically right here on the chart like that, there's absolutely nothing wrong with the SPX. It's continuing its uptrend. It's doing its thing. Mm-hmm. If somebody wants to understand maybe what are the risks of a correction, what are the chances that instead of this just powering through and going to 6,000, 7,000, 8,000, what are the chances that it does something like, instead of here, like what are the chances that it starts slowing down like it did in 2008, right?
Yeah.
I'm just going to drag this here. Oops. I'm going to make this line bigger. What are the chances it does something like that, right? That where everybody thinks it's going to go super high, it just goes up a little bit and goes down. We have to look at ratios. We have to look, how is the SPX performing versus its competitors? Yes. So let's say here I have the SPX. I'll do SPX divided by the yields, 10 TNX, 10-year yields. This is the SPX versus yield. So even while the SPX has been going up nominally, we know the SPX is much higher, right? Nominally, I'll add it for your viewers so they get to look at it. New pane. I'll remove this. So here is SPX versus the yields. Here is SPX versus the US dollar, right? 1 unit of US dollar. So while it's been going up, in real terms or measured by yields, the SPX has already broken down. So instead of being above a 1 year and 3 year moving average and being an uptrend, it's actually the opposite. It's below a 3 year moving average. Still declining.
Yeah, still declining. Yeah, I see.
Yes. So you're not in you don't have all the tailwinds of a US growth stock bull environment. Because I'll show you here. Let's zoom in back in 90. I'll zoom out. I'll zoom here. Look what happened here in 1982. That was like all the way to 2000. That was probably one of the greatest bull runs in US equities. But look what happened here in 99. We had the blow off top in the US stocks. It was going high. But look, it was going sideways and down versus the yields. I'll zoom in here, guys, just to give you a little bit more granularity. It was starting to lose rising trend lines. So just the steeper rising trend line guy it breaks. Yeah. Just you're losing the momentum as defined by that rocket ship. And as soon as the trend line is like a horizontal plane, that means there's almost no upwards momentum anymore. So here, there's upwards momentum. It loses it, but there's still room for it to go up. It goes up. That's versus the yields. And then after that, it keeps going up. It's doing a higher high nominally. But look at after that, it's not able to break out versus the yields, and the price gets rug pulled. It goes under. So to have a true bull era, you want the SPX to be breaking out versus the yields, going up versus the yields, and that creates the tailwinds for true growth bull era. And look, we're not there yet. So people got to look under the covers. You could rationalize this. A narrative you could spin around that is the inflation rate is still too high. It's still going to impact profit margins. They're going to have to cut down their employees. It's going to be hard for them to grow in that higher yield environment. So that's a major look, I would get very bullish US stocks, very bullish once it's able to do one of these scenarios. Once it's able to go back above the 1 year and 3 year, but there's so much damage done. And I'll tell you one thing about charts and damage. Once you go down that much, it creates a whole bunch of resistance levels along the way. So that's another basic concept of chart trading.
Yeah.
Previous support, support's good, but once it breaks down, that becomes resistance. So whoever lost money here, as soon as the price goes up, they're going to say, oh man, I have to break even. And that it's like, it's like everybody who held on, let's say to silver, they bought at silver in 2020, and then it went down, and then it created a wall. So as soon as the price goes up, so you need time to heal. You need the people who bought higher, they need to go away. They need to have reallocated. You need to heal all that damage done with these bag holders. So usually that takes time. And there's a huge wall here. So look, you see the damage. For the US stocks to be in a bull era, it would need, I could do a little roadmap. And it's always good, guys, to just imagine it would probably have to go up here, but then it would retest that rising trend line from below. That's resistance. It would have to retest that declining 3 year moving average. So it's probably going to go down. I don't know how low, maybe retest here. It's like before this breaks out, we could be in 2025 before it truly has healed from all the damage. So while nominally it feels great, it's not the best environment for US stocks right now. You got to be really wary of rug pulls.
Yeah, I agree on that.
I could even do another example. Here's SPX versus uranium. They're the metal. So here's the U.UN. It's a Sprott. I could have done divided by UX also. That's the Sprott physical trust. Here, I don't have a lot of data, but look, it broke down. The SPX broke down in 2021 versus the metal uranium. So that rising trend line, that momentum broke down below the 1 year, below the 3 year. Here, it broke down from a horizontal plane, right? So there's no more upwards momentum. It broke down, tried to retest from below, failed, and it kept falling. So it's not supposed to happen in a US growth stock speculative bull era. It should
Yeah.
not be falling apart versus uranium. It should be doing like what it did here back in 2011 versus uranium, the metal. It was above a 1 year, above a 3 year, broke out, retest, and above the 1 year, above the 3 year, above the cloud. That's what should happen in a. So again, it's an illusion what we see now in the US speculative in the indices right now. It's a fiat illusion. It's going mostly because there's destruction of the unit of the US dollar more than because it's truly in a bull era where it's outperforming everybody. So
Yeah.
this is not, look, you could start getting bullish US growth stocks once it gets above this line, but that's not enough getting above that line. It needs to work out. It needs, oh goodness, look at the damage. It's crazy. Like it needs to work. It needs to do, like it needs to do that there. Goodness, it's like it could break out again in 2025.
Yeah. Yeah. Yeah.
It doesn't have the headwinds yet there. The tailwinds, sorry, it doesn't have the tailwinds
Yeah. 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 I see.
necessary to have less chances of the proverbial rug pull.
Yeah. Pat, let's cover uranium some more. We are seeing that uranium spot price is going nowhere but up. Sentiment is very good for equities as we speak. Okay, maybe not for small caps, like I said, but big names are performing well. Where are we now in the terms of charts? What are they are telling you about uranium?
Okay, you want to cover the metal or one of
Yeah,
the?
yeah, the metal.
Okay, let's go with the metal.
Then we can cover maybe some of the uranium names.
Look, uranium, it's just, that thing's just bonkers. Seriously, it's there's a trick we have, not a trick, I don't want to call it a trick, but it's scientific, it's mathematical. The distance from the moving average. So here in the bottom pane, I have the distance from the 36-month moving average.
Yeah.
The further you are stretched away from a moving average, the more the price has accelerated fast, and it triggers thresholds of noticeability with the crowd. Like when the price just goes up slowly, nobody really talks about it, and it could a price chart that just goes up slowly about the price chart. It's like the frog in the boiling pot. It's like not going to realize what's happening. But if it goes up too fast and stretches for the moving average too much, it wakes up people, and people, they're going to pile on and stretch it even more. But all the people who bought at the base, they're going to probably want to take profits now because now the price has stretched so much. It's like almost an excuse, it feels like I have to take profits because it just went up so much.
Yeah.
So here in the run of 2022, uranium was able to stretch 81% above its 3-year moving average. Right now, we're at the same level where it petered out last time, where it slowed down. It doesn't mean we have to slow down here, but statistically, we're levels where it is stretched from the moving average right now. It's like, as long as it stays, look, anybody who's long uranium is fine as long as you're above the 1-year moving average, as long as you're above a rising trend line, it's still an uptrend. But what could be logical to anticipate eventually is a correction. And a correction it could happen in two manners. A correction essentially is letting the moving average catch up to the price. It could happen either the price just goes sideways, like really tight, just sideways, and over time, the moving average catches up. Or it could be a severe correction, and that also resets the price, and then it lets the price bounce on the moving average, and then after that, it resets sentiment. It creates a beautiful pattern where people could buy again, just like this correction here. That was just beautiful. It was an opportunity, to enter. But right now, you don't end on something like that. There's no low risk, high reward entry. There was only, here was the low risk reward entry was back in 2021. Here was another one, 2023. There's none right now. Right now we're in it's frothy.
Yeah.
But I'll show you an example here.
So the low 70s are in the game here. Sorry, if you can return.
Yes. So like, where's the 1-year moving? The 1-year moving average is at, whoops. 1-year moving average at $62. Yes, I don't know how low it's going to go, but it's still it-
Yeah.
you're high now. You're high now. I just noticed here there was a support. So yeah, it could go down to 72 there, no problem,
Mm.
and still be in a bull era.
Yeah,
It's
yeah,
a
yeah. That's what I mean.
yes, yeah, it could go easily all the way here to 72. Let that 3-year moving average catch up. And what's good about the charts, draw the lines, guys. Visualize if it makes sense. Often I hear some crazy targets and like, where's the 3-year moving average going to be? If it can, yeah, so that would be a great opportunity if ever this happens to let it heal. And
Yeah.
so it could continue because I'll show you here. Unfortunately, I don't have that data feed anymore, but I had the uranium spot price going back all the way to the 80s. So this chart is the uranium versus SPX. So it's almost going back to the chart before the chart. It's uranium's performance versus SPX. I did this chart back in October of 2023. The people often they use ratio charts to see if something's cheap or expensive versus
Mhm.
another asset class. This was the peak in 2007 for uranium versus SPX. And look, in the 80s, I saw the chart on Google, like in Google, uranium versus SPX there was super low and it went like that high. That was the ratio, like 1 ounce of, or I think it's a pound. They measure uranium by the pound, right? They measure
Yeah, yeah.
so 1 pound of uranium could have bought you, or the SPX, or 1 pound of uranium was 0.4 the price of SPX. Like that was the peak in 1980. In 2007, 1 pound of uranium was about 0.12 or
Hmm.
0.10 of SPX.
That's
Look
very
how low,
interesting.
look how low we are here. We're
Yeah, yeah, I see.
nowhere the levels of expensiveness versus SPX.
Hmm.
We're not even close. It's like when you see this, and that comes back to like the introduction,
Yeah.
charts could help you. So even while $90 a pound is in front of our eyes for uranium, in relationship to the SPX, it could go so much higher because I'll tell you something. It's called the fiat illusion, guys. It's
Hmm.
like I don't know, in Croatia, you probably have inflation like us, right? You hear the stories from your grandparents saying they bought milk for 5 cents. And
Yeah.
then, it's like it's across the planet, right? So
Yes.
people think $400 price of uranium is expensive, but if the unit of the currency you're measuring it has been depreciated, then it didn't go up that much. The only way you could know if uranium is really like frothy versus it's measuring it versus other asset class, take out that fiat illusion of destruction of purchasing power where it's going downhill over time.
Yeah, yeah, that's a very good point, Pat. That's a very
Ah,
good point.
there's no
I,
limits. Sometimes I'm sorry, like somebody mentioned that, oh, $300 oil will break the economy. Well, maybe not. If they're doing so much destruction of purchasing power, $300 oil, it ain't that much anymore. It could be the equivalent of $100 like
yes,
5, 6 years ago. Look, people thought $100 oil back in 2000. If somebody would have said $150 oil barrel, it breaks the economy, while the barrel was maybe $25. I don't know what it was back in 2000 or 1999. Because they're destroying so much the unit of purchasing power, it didn't break anything, right? It went up to 150,
exactly.
down to, it's like it's not the end of the world, nominally a high value. And look here at the bottom, the 7-year rate of change. The 7-year rate of change is how much that ratio has moved today versus 7 years ago.
Yeah,
And we're nowhere close. It's like it. This doesn't mean it has to outperform the SPX, but
yeah,
if it was to outperform the SPX for the next 5, 6, 7 years, there's still a lot of runway. It's like we're not at the end of this there by any means right now.
yeah, yeah, exactly. And Pat, do you have some charts of, let's say, Cameco, some of the big names from
Yes.
for uranium? Let's cover them.
Look, yeah. I don't know anything about the fundamentals. I'm sure
Yeah, yeah,
you can.
sure. From your technical side, nothing about fundamentals. I'm just curious about technical side.
That's right. It's like I talked to
What
some
are the
people in this.
charts telling you?
Yes. Well, the chart's telling me that, and I'll show you the exercise right now. I'll do it here. So on the bottom pane is distance from the 36-month moving average. So here we have we had one touch point, two. It was able to stay above that 100%, 106% above the 3-year moving average in its blow off top. It lasted longer than it lasted a while here. Here in 2022, we actually stopped here. So this is what I call the profit taking zone here, or the FOMO profit taking zone. If ever the price continues stretching itself and we start hanging at that level or above that level, you got to really zoom in maybe on the smaller time frames to get ready to bail. So let's say here we're back in the 2000s. The price is stretching above that red line. Here, you'd think that it would be a blow off top right here.
Yeah.
You think it's a blow off top. It's slowed down. It went sideways a little bit. It let that 1 year moving average catch up. But it didn't. It let the 3 year moving catch up a little bit, but it kept going up right after and after and after. The sell signal would have been once you started closing below the 12-month moving average, below a rising trend line. So now you're starting to lose momentum on the shorter time frames. If somebody wanted to start taking profits, that would be a great opportunity. Even if the price went up after, it was still not a bad move to take profits when momentum slows down, because you want coiled and tight moving momentum as defined by moving averages. You want something coiled and tight here, expanding away. And while nobody believes here in Cameco, nobody believes here, and here everybody's talking about it. The big money, the lower risk, higher reward entries are made when it's coiled and tight, not when it's expanded, right? You want to enter down here. You want to enter here, coiled and tight. But look, it stretched, and now we had a second opportunity. It reset. It let that 3 year moving average catch up. Here we were only 21% above that red line. It exploded away. So right now, as long as you're above this line here, as long as you're above the 1 year moving average, it's just in a bull run, right? But there's no low risk entry here because you're kind of trapped in no man's land. Like I said, the entry was here, and the exits are found here. So we're not quite at the exit, but we're not at the entry. But it's just right now we're in an uptrend. It's just an uptrend. And where is it going to stop? Well,
yeah, but is the stock overbought right now?
look, there's no, it's an uptrend. So you want it overbought, and you want, and it could keep like this. People could have considered overbought, but it could stay overbought for years. It's like,
exactly.
you don't sell because it's overbought. It's the transition from oversold to overbought that should wake you up. Oh, something's changed. Big money, something's changed. The dynamics. It was completely undersold, and it shot up into overbought territory, and that's great. And then once in the overbought territory, that's when something like this there. I could have drawn a line here, maybe. I could have made a case that anything above this line here is the bull zone, and as long as it stays above it, it's just going to oscillate in that overbought area, which is that's where you want it to be there. It's not because it touches an overbought that you want to automatically sell. It's if it breaks down from that overbought. Let's say it would break down from this 1, 2, 3, this rising trend line. Once it starts breaking down below that and momentum tampers or just dwindles, then that's when you're at risk of momentum shifting downwards. Because think about it this way. Let's say you're going 100 kilometers an hour on the highway. Before you go in reverse, you have to go to 90, 50, 0. Then you go in reverse, right? It's not like, unless you hit a wall on the highway, most of the time you're not going to hit a wall and go from 100 to like -5. You'll spot it on the chart. So the higher the steep, the faster you're going. And as soon as it starts slowing down, oh, you're going 70, going 50, then you could just get out of the car and go into another instrument, which is it's breaking out. Go find another uranium stock, go find another sector that's copper, whatever you want, that it's done the hard work for you. All that 2 years of waiting period. You don't want to buy in a downtrend for 5 years. What are you going to do? Tell your wife as your portfolio is down 20, 30, 50. She doesn't care about uranium. She wants money to feed the kids.
Exactly. Pat, can you show me a Nexgen chart?
Yeah. Nexgen.
Yeah, the first one.
Goodness, I haven't looked at that one in a while. Yeah, so Nexgen, it broke out here, just like Cameco starting to move up. It has some juice in it. This one still has you could make a case that the profit taking zone would be 108% above from where we are. So I'll just do a little so what I'm doing, guys, here, I'm looking at the sampling, where, see, it touches from above, from below. So this line, once the price is about 109% above its 3-year moving average, it could start slowing down. So here, I just here's my tool. You see, guys, here it says 111, just about like 109%. Here's my red line hopefully your viewers get to understand a little bit because I go into details. They
Yeah,
start
sure.
understanding the thought process. So as the price trends above this 3-year moving average, which I'm extrapolating that it's probably going to be this angle, the longer it takes to reach that line here, the distance from moving average, the higher the price is. So right now, if that thing would just keep trending here, we could be at $12, $12.25 by the time it's where it gets frothy and it's going to beg for like a consolidation, right? I could also do some classical TA on that. So here's the base, pull, flag, and then you add the distance of the pull. And look at that. So here you have, maybe this is telling us that we'll be able to, maybe at $15. So as soon as you start hitting the distance from MA starts hitting 109%, because over time, 109% from today, the target's much lower. So if it would shoot up today, 110% above the 3-year moving average, again, it triggers people. They're going to start selling, and it could create already that ceiling. But if it climbs slowly, the slower it climbs up and just does a blow off top in 1 year, then we'll have a higher price point. It's all about how fast it decides to blow up. You don't want melt ups. You don't want uranium squeeze. Nobody wants that now. Let it climb up slowly 2-3 years. You'll have much more gains because once it does a blow off top and you exit, it's done. You have to wait.
Yeah, that's my point. From time to time, I always tell to my audience, it's better to have a steady rise than a sharp rise and violent move. That's definitely a better scenario. Pat, can you draw me a UEC chart? UEC, Uranium Energy Corp, please.
Are these big companies? Yeah.
Yeah.
$2 billion company. Yeah.
Look. Those three are among the biggest. Cameco is the biggest, and Nexgen is also a big company, and UEC is more than $1 billion market cap company.
So look at this thing. This thing has a 2007, 1 hit, 2 hits, 3. So look, another chart trading tip. You need three reactions on a trend line for the trend line to morph into existence. So here you have 1, 2, 3 breakout. So this thing actually broke out.
Yes.
In September of 2023. It's on its way now. So it did a false breakdown here. Like URA looks like that there. It did a false breakdown below the 1 year, below 3 year, and then it did a reverse move. That's very bullish. When you have reverse moves on charts and price action, that messes everybody up. Everybody was piling down. They were wrong. So they have to cover their shorts, creates upward pressure, and now they want to go long. So it creates it creates a reverse move the opposite way. I'll talk to you right after that about the volume. So right now, same thing as Cameco, above an inclining 1 year, above an inclining 3 year. So if you're in, you're fine. Now it's just about when you want that to keep climbing up. So here, 127% above the moving average. Let's do 127%. So as long as that thing climbs slowly, then you could be expecting $10. It depends how fast, right?
Yeah, of course.
But if it breaks down from here, if it doesn't reach that, and the momentum, I'll here, I think, pretty sure I'll do my pull flag. That one's a little bit messy there, but if ever it doesn't reach it, you got to respect the price action. So if ever the price closes below the 12-month moving average, first warning sign, you're on the highway, you see the traffic slowing down in front. You don't want that, right? You want it to keep the same speed or accelerate, right?
Yeah,
But
sure.
it's in an uptrend. Chemicals in an uptrend. UEC,
QEC.
Nexgen is in an uptrend. Like even URA there, the whole
Or try Denison Mines, DNM.
yeah, I love Denison's pretty cool also. Yeah, look, they all, and this is the thing. I'm not talking about I don't want to talk bad about company fundamentals, but I'm sure some specialists in the uranium field, some of the guys you've talked to, they will tell you Denison has good management, Cameco has better management, UEC is better, or somebody could tell you Cameco is horrible, they're overvalued. But look,
Of course.
all these charts, they look alike. Why? A curious mind should ask themselves, what's carving out these price charts? Even I'll tell you one thing, and you've seen these, the penny stock scams. People call them, sorry about my language, as shitcoins. I saw a meme, it was so funny. The guy had a big cigar. He says shitco uraniums. But it was funny because he's right. Because once the money starts flowing in the sector, all these charts are going to look alike. They're all going to look alike pretty much, right? I could overlay all these charts, just the scale is going to change. It's either penny stock, big
Yeah.
cap stocks. I could overlay Laramide or Paladin. I don't know, Paladin's a big one, but I could overlay tiny companies and they're going to look like that. And look at that thing. It's beautiful, Denison Mines. Same thing, above a 1 year, above a 3 year. As long as it stays above the moving averages, you're in an uptrend, right? It's
Yeah.
this resolve here, all this hard work it did here, it exploded above the 1 year, went sideways, below the 1 year, above the 3 year. So that's shorter term moving average breakdown, momentum, longer term supports.
Mm-hmm.
It did the hard work for you. The market has chosen a direction for you here. It consolidated 2 years and it's moving upwards. It didn't move down. It's moving upwards. It's telling you something. You have to stop the doubt and just say,
Okay.
look, that's where the money flow is going in, no matter what the narrative is. Maybe there'll be a worldwide ban on uranium. Let's say there's a Fukushima and something explodes. The price could
Yes.
still go up here. You think it's bearish news, but the money's going in and it's overriding whatever bearish news you have, right? So people
Yeah.
have to respect the price. And that thing, yeah, it just looks like a nut trend. Nothing wrong here.
Nothing wrong here. Yeah, I see. Please, Pat, one more. enCore Energy, EU.
$600 million company. So pull flag. Here was an aggressive breakout of a rising trend line. See, that was a pretty steep correction. And yeah, it's trying to move upwards there.
Okay.
But it hasn't. Here's a wall. I'll just zoom in here. That's above the wall. So a wall is, I think I talked about it right before, it's previous support. Once it breaks down, it becomes resistance. So all this topping pattern here, price broke down and it decided to go above. There might be another tiny wall here. The next wall is right here. There's sellers coming in. You want to overcome that. But yeah, it's an uptrend. But it doesn't look as good as let's say Cameco. And guys, here's another trick. Do EU divide by, let's say, Cameco. So now you have the ratio. What's the performance of EU versus Cameco? So EU has been underperforming Cameco since, well, here was the peak in 2021. So when you see a chart like that, it should tell you that there was absolutely no reason to be long EU after February of 2022. There was no reason. It was starting to be, it lost the 1 year moving average. Here it lost a 3 year. But now it regained the 1 year, but it still has overbearing resistance. So you got to wait to see if EU is able to mount a comeback and do something like that eventually. But right now, performance is bias is neutral, bearish for EU versus Cameco. Cameco still to be favored at this stage there.
Okay. Pat, let's get to gold, precious metals, silver and gold. What is the situation? Let's start with silver, maybe. What is the
All right.
situation there?
Okay, well, silver, and I'll show you a chart right after that that's going to explain to everybody what are the capital flows, the macro that's driving the silver price. Often you hear somebody who's new in the silver sector, it's manipulation, JP Morgan, the bullion banks. But I'll show you a
Pretty
chart
much
right
the
after
same
this one.
always.
that's should shed some light. So silver here broke out of a descending trend line. So the momentum as defined by that descending trend line, it broke out. It's above the 1 year, 3 year. We're going to wait to see how it closed the month. You want it to close back above in the next couple of hours. You'd like for it to close above here. And here's the next line in the sand. Well, we know 28 is like 27, 28 is really going to be where it's going to go really bonkers once it overrides this wall here. But there's a wall, there's a little wall here. Yeah, 25.50. So if ever it's able to close back above 25.50, 25.40, but it's definitely not in the downtrend. It's moving upwards, and there's some bullish stuff. I'll show you a chart right now that's going to really crystallize why it's bullish for silver.
Yeah.
I'm just going to overlay over it. It's gold divided by inflation. So gold's performance versus inflation carves out is what, oh goodness, I didn't do it right. XAU USD divided by CPIA. Gold's capacity to outperform inflation is what silver tracks. So I have it right here. I'm going to click and drag, put on top, put it log scale. Look at that here. This is a silver chart going all the way back to 1970s. And the orange line, maybe I'll make it, let me put it black.
It's pretty messy.
It tracks it. So let's forget the fundamentals of silver. Let's totally forget. We don't know. There's 10 million ounces out the ground, in the ground, like all that put aside. Just gold divided by inflation, just that singular chart silver tracks it over 40, 50 years. It's been tracking it very, very closely. And I'll tell you why this is important. Check out what's happening now. It's starting to break out there. Gold is starting to break out versus inflation once again. This is crazy stuff. So now you have tailwinds as defined by gold's performance versus inflation, which should give you comfort, which should help support the price of silver over longer periods of time, not like over day, like, price could go up and down, but the macro is very bullish. If gold was breaking down versus inflation, that's when you get end of bull eras, right? Let's say here, okay, that was pretty steep. Here's gold breaking a acute rising trend line. Here's gold breaking down versus inflation. And guess what happens to silver? It breaks down also. So this very bullish for silver, the fact that gold is able to outperform inflation. Very, very, very bullish there. It's great macro evidence to add to the case of precious metals. I could look at the Swiss franc. I'll add on top of that the CHF USD new price scale. And okay, it's starting to get messy. I'll just keep silver here, remove drawings. Here is this one here, put on log scale. The Swiss franc, the capital flows as defined by the Swiss franc versus gold, same story. And it's breaking out versus gold right now. I think we actually have a confirmed. It's breaking out the Swiss franc. Well, let me flip it. Invert scale, that one, invert scale here. Okay. Here is Swiss franc is breaking out versus the US dollar.
Yeah,
so
I see.
That's very supportive. That looks the gold chart looks exactly like that. If I overlay the gold chart, I put on log scale right here. Look at that. That's the gold chart since 1971. So whenever the Swiss franc is able to break out versus the US dollar, steal those capital flows, the US dollar, the gold, an ounce of gold expressed in US dollar, it tracks that over long periods of time. So now we got gold breaking out versus CPI. We got silver starting to break out. We have gold. I'll cover the actual gold chart right after that. We have gold. Please. We have this, the US dollar, the Swiss franc breaking out versus the US dollar. And let's just look at the gold chart, like, and that's how you do it with charts, like the weight of evidence there. Just keep building the evidence, and it helps your, I think like a thesis should be derived from the charts, right? Because the charts
Don't lie.
are, yes, well, look, I'll tell you something. Oh, sorry. The charts, there is a way to make the charts lie, like it's called, I could put a shorter time frame, you know,
Yes,
put
of
loud
course.
scale. Like people do tricks, you know. I know I've been in the chart. Sometimes I've been guilty. Like I've done a chart and then I realized that I didn't do it objectively properly. But
Yeah, like you said, depends on the time frame, and you can adjust that. I agree on that.
yes, here's the gold chart. Let's say, so here's the gold chart on the monthly time frame. Clear breakout last month.
Yes.
Even there was a scare, it went up, down, but that's just right now, that's just like a doji, a spinning top. It's just a consolidation. It tried to go up, it would try to go down, and it's ending pretty much where it started the month, above an inclining 1-year moving average, just like we covered for the Cameco charts and all that. You're above a 1-year moving average, above a 3-year moving average, above the cloud. Check, check, check. You're in uptrend, right? So you shouldn't get stressed out because we went to 2100 overnight and then it dropped down. The market's telling you that the breakout, as defined on the monthly chart, has not been overridden, right? It's like here in March Madness, this candle, that was a crazy candle when the COVID panic. It went up, went down, and it closed exactly where it started. Like no harm done.
Yeah. It looks funny.
It had the buying pressure because it was already an uptrend before. And that's why I tell people sometimes there's news. You think it's the news that's carving out the price, but if you zoom out, it had already broken out in June of 2019. The capital flows were already going into gold for months and months before March of 2020. So even if it was an occasion on a shorter time frames to sell it and go up, sell the run, it was still not predestined, but you still had the more odds of going up than going down in 2020. So look, gold's looking great on its own chart. Let's go on the yearly chart for gold. Look at that thing. It's like it broke out, highest yearly close ever. It's another breakout. I could go on the semestral chart, the 6-month candles. You could even make a case that, well, it's like you could almost make a case that it already broke out at the beginning of the year. And you see, even if the sellers came in, that's the wick, the sellers came in, we're still in uptrend. We're still above that's a 3-year moving average. That's you're still above inclining moving averages. There's nothing wrong here. And on the quarterly chart, which is which closes today, even here, an aggressive trend line rising. Usually when that breaks to the upside, that's bullish.
Yeah.
Unless it goes up and then it could do a reverse move down. But if it goes up, retest from above, we could be dealing with just like popping a pimple there or popping something, a balloon, and it just gets squeezed up. And it's happening now. It's like it's crazy there. Like we're going to be posting stuff for our members like in the next couple of weeks. Me and Kevin will be working overtime because we're going to get great signals, you know. US equities, going up nominally, great.
Yeah.
But still wary of rug pulls. Gold breaking out on multiple time frames. Uranium already doing its thing. Silver getting really close for itself. Well, if we go back to the first question, which sector to go in?
Yes.
Well, silver, it's getting close there for a full-fledged bull era. You know, there's many reasons to enter or exit in equity. Like silver, maybe on the shorter time frame, somebody could have already entered a few weeks back. But when I'm talking about the total weight of evidence, and often you're not going to wait for every single piece of the puzzle to fit before you go in, right? If you have enough evidence that is enough for you to get in, then people will go in before or after later other people, right? That's probably why some people enter later in the bull era than the early birds, right?
Yes, exactly.
It's like everybody has, requires just somebody, they're gonna go play the casino with just bare like zero understanding. They're happy. But some people is going to want to study the books, do the YouTube, you know what I mean, before they play poker, right? Everybody
Yeah.
decides what they want to do and what they're comfortable with, because this is what I call emotional capital. People think about capital money, but that's not. If your emotional capital erodes, let's say you're a basketball player or boxer and you're doing great, you're beating the guy, but by the 10th round, like your brain's tired, just shuts off. You can't think straight. You're going to lose the fight. Same thing in trading. You
Yeah.
could be in Cameco, it's going up, but you're fighting with your wife. There's trouble at your
Exactly.
work. You're not
Yeah.
thinking straight, and then you're gonna make mistakes. You're not gonna think rationally. So,
Yeah, that's the most common mistake. I agree. Pat, before I let you go, let's do copper and that's it, please.
all right. Man, it was a total showcase today of the whole. I hope this gets a lot of views because it's we covered everything there.
Yeah, yeah. Really, I really appreciate that.
All right, here's copper. So copper's in. You'll see it's mixed evidence.
Uh-huh.
It's above a true bull run for copper. It needs to be above the Ichimoku cloud, above the 3-year, above the 1-year, breaking out of a trend line. That's where you get these crazy moves. But what happened a little while back, it lost the rising trend line. So again, you're on the highway, the speed slows down. It lost the 12-month moving average. Speed slows down more. And now it's trying to regain it. There's a wall here. See, it wasn't able to overcome this support turn resistance.
Yeah, I
It's
see.
it's trapped right now. So it's trying to resolve. And that's why people in classical TA, they say triangles. You know, triangles essentially is the volatility is contracting and the market eventually is going to choose where it wants this thing to go. So it's right at the 1-year moving average. It's below the 3-year. It's above the cloud. So there's support below, there's resistance above. It's trapped. So we're waiting to see how this thing's going to resolve, because I could zoom out and essentially if this resolves upwards, what we're dealing with is just a huge flag here with like $7 copper there if ever this thing breaks to the upside. But you have to wait, you know. Right now it's coiling. I could even do, I know you want to just do oil real fast.
Yeah, yeah, sure.
So here's oil. Same type of thing as copper. Here is oil. Here's a trend line that started in 2008, 1 touch, 2 touch, 3 breaks out, retest. Just like copper right now, it's coiling above long-term support,
Yes.
below the 1-year, below the 3-year, above the cloud. So that thing just needs time to do its thing there before. This is probably, here was the breakout of the base. So we just got to wait for oil. But because oil, there's you know, a lot of the shipping companies are doing good. A lot of the oil plays are hanging in there.
Yeah.
It's giving evidence or confidence, whatever word you want to put for that, that you could expect a resolution upwards. But this is the thing about chart patterns. Chart patterns are only possible chart patterns until they complete. Oh, head and shoulders stop. Fine, it's possible, but you have to wait until it breaks down. Then it's a chart pattern.
Yeah, you have to have a big picture, of course, the whole picture, I mean. Patrick,
Yes.
I really appreciate for you taking so much time, and we really covered uranium, copper, silver, gold, some stocks. Thank you very much. It was really a great chat, and let's stay in touch and do this more often.
Yeah, definitely there. Just beat me up and I'll jump on board.
Thank you very much, Pat.
All right. Thank you, sir.